If you've been paying attention to real estate headlines at all, you probably have noticed that one word keeps coming up: bubble. Are we in a housing bubble? Is the market about to crash? Oh no, what if it would? Should people wait before they purchase a home? Did people already make a mistake? And those questions do not come from nowhere. They come from memory. A lot of people lived through the last housing crash. Some lost their homes, some watched their equity disappear, others watched friends and family struggle, and even people who were not directly impacted still absorbed that fear. So when prices rise or rates move or affordability feels tight, which it does, that memory comes back fast. Today, we are not here to predict the future. We are here to understand the past because that is the only way to make sense of the present. This episode is not about hype. It's not about fear. It's not about convincing anyone to buy or sell. It's about facts. According to the economist at the Federal Reserve, housing bubbles are not defined by feelings or headlines. They are defined by structure. So today, we are going to talk about structure. We're going to walk through what a housing bubble actually is, what caused the last one, what the warning signs look like, how today's market compares, and what consumers like you should actually pay attention to. I'm Dustin Owen, and this is The D.O. Show.
They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built $1 billion mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to The D.O. Show, where I teach the lessons life taught me the hard way.
When most people say bubble, what they really mean is, well, this feels expensive. That's understandable, but it's not accurate. According to research published by the Federal Reserve, a housing bubble occurs when prices rise far above what income growth, rents, and long-term demand can support. And that rise is fueled by speculation and most times loose credit. There are two key ingredients in that definition. There's speculation and there's loose credit. Prices alone do not create bubbles. Prices can rise quickly in a healthy market, which we're probably in, if supply is limited, which is what's happening, and demand is real. Prices can also fall without a bubble ever existing. A correction is not the same thing as a collapse, and I want you to think about that. Real estate markets move in cycles. They expand, they slow, they rebalance. A bubble is different. A bubble forms when buyers stop asking, "Can I afford this?" and they start asking, "How fast will it go up?" That shift in mindset is what changes behavior. People stretch further, people accept more risk, people ignore fundamentals. And that is when trouble starts. So to understand whether today looks like a bubble, we need to first understand what actually caused the last one. Let's talk about the housing crash of 2008. I lived through this. According to extensive post-crisis analysis by the Federal Reserve, the Consumer Financial Protection Bureau, and the Mortgage Bankers Association, shout out to my friends at the MBA, the crash was not caused by prices going up alone. It was caused by a collapse in lending discipline. In the years leading up to 2008, mortgage credit became dramatically easier to obtain. And let me walk you through what that was like in real time because I lived it. Here's what happened. You had Wall Street investors that were asking mortgage lenders to create more and more loans. The problem was there weren't that many more qualified home buyers. So what did Wall Street do? Wall Street said, well, let's get a little bit more exotic. Let's get a little bit more loose with our credit standards. What that looks like is this. In the beginning, Wall Street was willing to lend money to somebody who had bruised credit as long as they were putting down at least 25%. Then someone else came and said, well, we ran out of those qualified buyers. What if we increased it to where you only need to put down 15%? Then someone else one-upped them and said, I'll do it with 5% down. Next thing you know, we are in a bubble. According to the Federal Reserve Bank of Chicago, subprime mortgages accounted for more than 20% of all mortgage originations by 2006. Just a few years earlier, that number was closer to 6%. Hence the example I just gave you. Subprime is not moral judgment. It's a risk category. It means loans were being made to borrowers with a higher probability of default. That alone does not cause a crisis, but what mattered was how those loans were structured and approved. According to the CFPB, underwriting standards weakened significantly during that period. Many loans were issued using stated income or low documentation methods. Now here's the deal, sidebar. Just using no income verification or stated income verification alone isn't necessarily evil. It's when you stack it with low down payment as well as below average credit. No different than below average credit by itself, not that evil. Stack that with low down payment and limited income documentation, you have a recipe for disaster. And lastly, using a similar example, low down payment by itself, no big deal. But you start stacking low down payment with what? You guessed it, limited income verification and bruised credit, and you can see where you're hitting the trifecta that isn't a winning combination. In simple terms, lenders were making assumptions instead of confirming facts. At the same time, risky loan products became common. According to data referenced by the Mortgage Bankers Association, adjustable rate mortgages exploded in popularity. And not the standard adjustable rate mortgage, but the exotic type. And there is a difference. Many of these loans featured what were called teaser rates. Those are the exotic ones. Those teaser rates kept payments artificially low for a short period of time, typically only 2 to 3 years. When those rates went to reset, it was impossible for them to ever go lower. They were only going to go higher. Here's the difference. Industry expert, we called those loans 228s or 327s. Today, you won't even find a 228 or a 327 because they're not healthy. They're not good products. You will find plenty of ARMs, and ARMs are a phenomenal type of loan for the right type of borrower. I myself have been in the same adjustable rate mortgage since 2006. Now back on those teaser rates, those 228s and those 327s, imagine millions of borrowers experiencing payment shock at the same time that the economy was starting to slow. We saw defaults increase, foreclosures rise, prices fall. And once prices fell, the system itself began to collapse. Not because housing was a bad asset, but because the system supporting it was fragile. Now here's where this gets important. The crash did not happen overnight. I repeat, the crash did not happen overnight. There were warning signs. Those were clear warning signs were documented by the Federal Reserve and that same Mortgage Bankers Association that we keep talking about, and they were documented years before. Let's walk through them. First, credit got easier as prices went up. According to the CFPB, again, that's the Consumer Financial Protection Bureau, lending standards loosened during the housing boom instead of tightened. That, by itself, is a red flag. When prices rise and credit expands at the same time, demand is being created by lending, not by income. Second, risky loan products became normal. Those adjustable rate mortgages that were interest-only payments coupled with low documentation loans, well, they stopped being niche and they started becoming mainstream. When people start saying, well, everyone is doing this, then caution disappears. And third, delinquencies began rising even when prices were still rising. This is one of the clearest warning signs of trouble. According to the MBA, mortgage delinquencies increased before home prices peaked. That means borrowers were already struggling even when values were high. At their peak, total mortgage delinquency rates exceeded 10% nationally. That, boys and girls, that's not healthy. And fourth, foreclosures surged. According to historical data published by the NBA, loans in the foreclosure process peaked above 400% around 2010. That level of foreclosure is not a correction. It's a systematic stress. And finally, buyer psychology changed. People relied on appreciation to justify purchases. And let me walk you through that in real time as if it was 2004, 2005 all over again. I would sit down as a young mortgage professional with a couple looking to purchase their first home. The first thing I would ask them is, what's your comfortable monthly payment? They'd give me something back in the day like $1,400 a month or $1,600 a month. I then would ask them, what type of homes are you looking at? They'd tell me I'm looking at a $225,000 or $250,000 home with 5% down. I'd run the numbers for them and I'd tell them their payment was going to be closer to $1,800 a month. So $400 a month higher than what they told me they were comfortable paying. Yet, you know what they did? They still bought that house. In their mind, they justified it. They were going to work a side hustle, get a part-time job, bring in a roommate, whatever they needed to do to justify purchasing and affording to live in said home. But guess what? That part-time job, it became a headache. That roommate became a nightmare. All of a sudden, they had a home they couldn't afford, but they just couldn't pass on buying. Y'all, that's a bubble. The only real reason a deal works is because prices are expected to rise. The decision is no longer grounded in fundamentals. That mindset, the one that I just described to you, that is what inflates bubbles. Now let's reset and bring this conversation to today. Because the only way to answer the bubble question, honestly, is to compare foundations. Not vibes, not headlines, but foundations. Let's start with lending standards. According to that same CFPB, one of the biggest changes after the housing crash was the implementation of the ability to repay rule. Y'all, I don't need the CFPB to tell you this because I've lived it. This rule requires lenders to verify income, verify employment, verify assets, as well as the debts before approving a mortgage. This rule did not exist before 2008. Does that mean bad loans do not exist today? No, of course not. But it means the baseline system has guardrails. Next, product changes. According to the cited data by the Federal Reserve, the vast majority of mortgages today are fixed rate. That matters. Fixed rate loans do not reset. Not that adjustable rate mortgages are risky. However, adjustable rate mortgages are definitely not for all people. And that matters. Fixed rate loans do not reset. Borrowers know what their payment's going to be. In the mid-2000s, payment shock from rate resets was a major trigger. And again, those are those people that went into those 228 and 327 subprime loans. Today, that trigger is largely absent. Those products aren't even available. Now let's talk about homeowner equity. According to the Federal Reserve's FRED database, homeowner equity is at an all-time high. This is one of the most important differences between today and the last bubble. Equity gives people options. According to the Federal Reserve, homeowners with equity are far more likely to sell than default during financial stress. Before the last crash, many homeowners were underwater. They owed more on their home than what it was worth. Selling wasn't an option. Well, today, that dynamic is very different. And now let's get into supply. According to Freddie Mac, the United States has experienced a long-term housing supply shortage following the Great Recession. In fact, from my experience, we are 1 million units behind where we need to be. You see, in the US, we are still forming more households than what we had in prior years, but home builders have not been able to keep up with the demand, largely because many home builders were still licking their wounds from the losses they incurred in years like 2008, 2009, 2010. Today, it is because of that underbuilding. That is what's supporting the prices. Those are opposite conditions to what we saw in years like 2006, 2007. Now let's talk about interest rates because this is where a lot of confusion comes from. Interest rates matter because they affect monthly payment. However, interest rates only impact one part of the payment, there's still homeowners insurance, taxes, and association dues. But for now, let's talk rates. According to Freddie Mac's primary mortgage market survey, mortgage rates rose sharply in 2022 and 23. Well, duh. Anybody who hasn't been living under a rock, who works in or around the mortgage and real estate industry, lived that firsthand. When these rates shot up, demand slowed almost immediately. That reaction alone tells us something important. Markets that respond to higher cost are not bubbles. In bubbles, demand ignores cost. Again, that's what we saw back in 06, 07, 08. According to our friends at the Federal Reserve, interest rates influence affordability, but not intrinsic value. A home can be a smart purchase at a higher rate if the payment fits comfortably. And it can be a bad purchase at a low rate if it stretches finances too thin. Rates matter, but they are not destiny. Now let's talk about prices, because this is where fear usually peaks. National indices like the S&P Totality Case-Shiller Index, published through the Federal Reserve, show broad trends. But real estate is local. Some markets are supply constrained, i.e. Chicago, Boston. Some markets are overbuilt, i.e. Austin or Tampa. Some markets face insurance pressure, i.e. anywhere in Florida. Some markets face tax pressure. A national bubble breaks nationally. Corrections are uneven and they're local. This is why consumers should focus less on national headlines and more on local data. Inventory levels, days on market, price reductions, employment stability, payment to income ratios. Prices alone do not diagnose bubbles. I repeat, they do not diagnose bubbles. However, foundations do. Now let's reset again and talk about one phrase that gets repeated constantly. Buy now, refi later. According to consumer guidance from the CFPB, refinancing is never guaranteed. Sure, rates may fall, but they may not. And even if they do, in order to refinance, you still must qualify, your income still matters, your credit matters, and more importantly, the value of your home matters. The responsible version of this strategy is simple. Only buy if you can comfortably afford it, and by afford it, I mean afford it today. Refinancing should be viewed as an opportunity, but not a plan. According to the CFPB, stretching today based on future assumptions exposes consumers to unnecessary risk. Now let's answer the big question directly. What would a real housing bubble look like today? Well, according to economists, a true bubble would include multiple warning signs appearing at the same time. Rapid loosening of lending standards, explosive growth in speculative buying, rising delinquencies while prices are still going up, widespread use of risky loan products, overbuilding across most markets. Like, those are the things, those are the conditions that it would take, and they are not present. Not on a national level. That doesn't mean that every market is super healthy. It means fear should not replace analysis. So what is the takeaway for consumers? What's the takeaway for you? The lesson is this. The takeaway is this. The lesson from past markets is not never buy. The lesson is to understand what you are buying, why you are buying it, and how long you plan to hold it. According to decades of data from all of the resources that I've cited, housing remains a long-term asset. Markets move, rates change, prices adjust. Consumers who buy based on a payment, stability, and long-term plans tend to weather all cycles. So avoid hype, avoid fear, understand fundamentals. That is how bubbles are avoided. And if you would like more information about what's happening in your particular market as it pertains to real estate or even as it pertains to obtaining a home loan, reach out to us. Here at TLOP, we have friends spread all throughout the country who are in real estate, they are in mortgage, they are in finance, and they are proven professionals that we can connect you to so that you can better understand your specific financial needs, wants, and goals and how they apply to the market where you live, the market you're looking to buy, or the market you're looking to call your next city. Thank you so much for taking time to check out the DO Show. I'm Dustin Owen. You're on my YouTube channel. If you haven't been here before and you haven't subscribed, do yourself and do us a favor. Click that subscribe button. We have loads of additional content, not just this show, but podcast, plus other short form content that you'll appreciate as well as enjoy. If you have a question, load up the comment section. I promise, whether it's me or a member of my team, we check those comments and we reply promptly. If you have a direct question, you can reach out to us. Start by going to our website, tloponline.com. That's the best way to reach out to us so that we can help you navigate whatever situation you found yourself in. And finally, remember, sharing is caring. If you found value in this content, I'm pretty sure you know at least 2 other people that also will find value. Go ahead, send them either this episode or one of your favorite other pieces of content that we've created, and let them know that this exists so that they can make sure they're learning the shit they don't teach you in school.